Time for a market review, which I know you guys have wanted because I've been reading the comments. And also, I've just been looking at the market. And this is just brutal. As I'm recording this, the S&P is down another 2%, and the NASDAQ is down another almost 2.5%. And I was checking out the NASDAQ, and what are we down now? Like 25%? God, it's brutal. And the first thing I want to talk about, even before we get into the market review, is that if you've had a tough time in the market this year, you are not alone. Everyone's been struggling. And more cash is just being pulled out because people can't handle it. So you eventually just give up. And I don't blame them. These are just your average investors, right? They're not on YouTube trying to figure it out all day. They likely don't have a system in place or anything like that, because even with the system in place, this market has been pretty tough. It easily shakes your resolution when your stops are constantly getting knocked out and you're constantly losing money, even with the system. So the first thing I wanted to say is that if you're struggling, don't feel bad. It's normal, especially in this type of market, which is like the worst type of market you could have. Because at least in a 2008 style market or a 99 style market where a bubble is popping, the market does, it doesn't go straight down, but it goes down faster than this. So once your stops get hit, you're out and you just watch the thing fall and you're like, hey, I'm doing pretty well. But in the type of market that we're in right now, which is more of a volatile sideways market, it just keeps pulling you back in and then knocking you out. And the problem is that, especially if you have a system, you gotta keep playing because you don't know exactly when it's gonna turn around. So it becomes even more brutal because you're constantly getting smacked in the face. So even with the system and a good strategy, and even when you think you got your mental game and your psychology all in place for times like this, it still sucks. But what you got to do is keep perspective, because when you look back on this time period 2 years from now, you're going to be like, hey, that wasn't that bad. That was actually a very small bear market. But of course, when you're actually in the midst of it, that's when it's painful. So always, you just want to step back, zoom out, and think about the larger picture. And also, like I always say, the stock market isn't everything. At the end of the day, what are we doing? We're watching numbers on a screen with fiat money just flying left and right, a bunch of digits going up and down. None of it's real. You know what's real? When you look out the window and you see the sun. When I look out my office window and I see the Detroit River, do I think, man, I should just jump in that river and just never come out? No, I don't think that. What I do is I look at the river and I say, oh, it's so beautiful. Then I look past the river and I see Canada, and I see Drake sitting there just being all sad, thinking, hey, should I jump in this river and never come out? And he's sad because he lost Rihanna, and then this Pusha T album was just so good. So I think to myself, hey, even though the market is going down, at least I don't suck like Drake. Nah, I'm kidding. I like Drake. I just like to think of him as a sad boy, which maybe that's what he is, and it makes me feel better. But the point is, go outside, live your life. The stock market isn't everything, so don't get too depressed. Even though this market has been brutal, just kind of detach a little bit, because you should be detached from this stuff. The stock market is not your life, even though it might feel like that, so don't forget that. And now, let's get into the market review. So the first thing we obviously got to talk about is that Fed meeting, right? What's going on? Because when they announced they were going to raise rates, the market rallied, right? Because they didn't raise as much as everyone thought they would, so hey, good news. And then the next day it collapsed again. So what does it mean? Well, here's what it means. The Fed meeting fell into neutral camp. And you already know this research is coming from MacroOps, our global macro research and consulting firm. So again, the day the news came out, people were saying Powell was dovish and the market was up. And then the market dropped because they were saying, oh, the Fed is hawkish. Actually, we changed our mind. But as we say, it's just the peanut gallery reading chicken bones. It doesn't mean anything. The Fed's 50 basis points hike and the kicking off of its balance sheet roll down next month was largely in line with what the market was pricing already. So, I've seen a lot of YouTube finance videos trying to describe what's going on in the market based solely off the Fed, but in general, what you got to realize about this last meeting was that it didn't have much of an impact. Everything was priced in. And most of the talking about it, at least on YouTube, is just our finance YouTubers. We got to make content out of something, right? And I took a little break from YouTube for the past 6 months, maybe even a year. I don't know. It's been a while, but I'm coming back and I can see the cesspool is even worse. So hopefully when we go over this research, it's cutting through some of the noise, because there is just so much noise. Speaking of noise, you can now probably hear the leaf blower outside my window. Okay, so what's up with the crazy action then these last few days? Well, most likely it's a forced liquidation, because there are some big funds that are trapped in holding bad businesses. And those bad businesses were the story stocks of the last few years. So think like tech stocks, right? A lot of them shot up. Well, most of those have round tripped, lost all their gains, and a lot of these funds are now down big. And we're gonna hear about some of them closing up shop over the next few weeks. That's what happens in these types of markets. We don't know that for sure, that's just what we're guessing. But I mean, think about someone like Cathie Woods just getting destroyed. Let's see, that ARK fund is down over 70% from the highs. And that's not really a surprise to us, right? Because you remember I made all those videos about how it was not gonna last. But what I also said in those videos is that for people like Cathie, doesn't really matter because they made all their money in the run-up, not only on the individual stocks and holdings, but on all the fees that they were able to charge because of all the money that flooded into their funds. So the way it works in the Wall Street game is just play it as aggressive as you can, capture that period, and then if you blow up after, who cares? You made your money, you're a billionaire, it's all good. And in this case, you know, like we were saying, these forced liquidations have caused a lot of volatility in the market, affecting a lot of people, hurting them. Again, who cares? It's Wall Street, right? You're not gonna go to jail, there's nothing that's gonna happen to you, so just play it, get your money and get out. But beyond that, what really matters is that stocks are being floored and yet bonds still can't catch a bit. So I mean, you already know bonds just continue to fall, and when bonds fall, what? Interest rates go up, right? And when rates are going up, that's even worse for these companies. And this is not what normally is supposed to happen. Normally when stocks are falling like this, which they continue to fall even harder as I'm talking, bonds will catch a bit because it's supposed to be kind of a balancing act. When people are scared to be in stocks, they go over into bonds. And when things are looking better, they go out of bonds and back into stocks. So they balance each other out. That's not happening anymore. So like Alex says, in an environment like this, bonds are supposed to act as a release valve, a sort of container for risk off. And that way it keeps it from spreading and accelerating. But when this inverse correlation flips, which is what's happening right now, stocks down, bonds down too, trouble happens. You get air pockets, flash crashes, and uncle points are hit. And you get this horrible market that we're in. But what it looks like is that we're starting to see the washout capitulation that we've been waiting for. And what is capitulation? It's when everyone has taken so much pain, they're like, I'm done with this, let me go into cash. And that's what we were talking about before, right? Well, the thing is with capitulation, if enough people do that, that's when you get a bottom in the market. Because if everyone's out, then there's only one move left, right? To put it back in. So a bottom forms and then you see the market rise again. So really what we want is that maximum pain capitulation to happen fast. And it's why I was saying like 2008, easier market almost, not really, but because, you know, it was happening faster. When you get a sideways market, which like is what we might be in, that's the most painful because then it just gets dragged out. It's like they don't kill you right away. They just torture you and drag you across a field until you die slowly. It's not nice. So ideally what we want here is a quick drop lower that lasts maybe just a couple of weeks, followed by a strong reversal. So like I said, this market continues to fall as I talk, so that might be the quick drop happening right now. You need like a final stab, you know, to just hit that bottom, to get everyone out of the market. And we had a rough Thursday and Friday, and this Monday right now is looking real bad too. So it might be happening. So you see blood in the streets, it's a good thing. But if this is not that, and we see a slow back and forth grind down instead, well, that raises the odds that we're in for a larger and longer bear market, which none of us want. So we rather take this pain fast, which again, looks like it might be happening, but we gotta see. This week is gonna be important. So there's a few signals that we're gonna be looking for over this coming week to see if we're getting a bottom. So of course, we're always gonna be looking at sentiment and positioning, right? We're gonna look for that washout. And we'll go over some charts below in a second. And the thing is, we don't need all the indicators to trip the level that we want to see. Maybe even half of them would be good. And the other thing that we want to see is that yields need to slow their roll and at least find a temporary ceiling. Because again, this just free fall, you know, the stock market's not going to stop falling until yields stop. Take a breather. And the thing with yields is that more than, say, interest rates rising, it's the rate of change in which they're rising. So if they're just shooting up really fast, you're going to get a brutal stock market. If they change more gradually, that's better. And the third thing we need to see for a bottom is multiple breadth thrusts. These need to fire following a reversal in the tape. And you know, we've talked about this before. We need the market to move up together. That's how you know it's a strong market. When I say together, I mean all the stocks inside the market. And you'll see what I mean as we go over these charts. So one we could look at is MacroOp's trend fragility indicator. You could see here that the last time that we got bottoms in the market was when this red line, which is the trend fragility, went and touched this green level. So that kind of represents the market resetting, and that's when you get a bottom. You see where we are right now. We're heading towards that green line, but we're not quite there yet. Another one we could look at is the nervous and numb indicator. And I don't know if we've gone over this before. I know we've used it, but I don't know if I explained it. So the nervous and numb indicator looks for divergences between the price action of the S&P and the VIX. So when the S&P is doing well, but the VIX spikes, it's considered a nervous market because stocks are steadily going higher, but the VIX spiking means there's fear. fear, right? The VIX is kind of the fear and volatility indicator. So that's a nervous market. But when the S&P is down, like when it's trending down and the VIX stays relatively stable or low, that's considered a numb market, which is what you would see possibly at a bottom. So the S&P often tops soon after a nervous reading, because it's almost like the VIX is signaling what's about to come, while the numb reading often marks a bottom, as I said. So if stocks are going down day after day, but the VIX isn't spiking, that means people are expecting it, and you're gonna get that bottom soon. So you can see here we came pretty close to the green line, the numb indicator, so that's a good signal for a bottom coming. Another one we wanna look at is the put to call ratio. Not close enough, no capitulation yet. We're still waiting for that to trend lower. And the put to call ratio is how many puts are being bought versus calls. So if you're buying a put, you think the market is going lower. If you're buying a call, you think the market is going higher. So that ratio kind of gives you the sentiment in the market. And again, not enough capitulation yet. Then we got the AAII bull bear reading, and you can see that has hit capitulation. It's below this green line, meaning people are very bearish. And again, these are sentiment indicators, right? And what do we know about sentiment? It's basically a reverse indicator, where if people are super bearish, that's actually good for the market. It means we're closer to a bottom. Because remember, capitulation, we want that bearish reading. We want all the money on the sidelines. That way the bottom can form. Another sentiment reading right here, the North American something something. I always forget the acronym. NAAIM. Not yet at that capitulation reading, so we're waiting for it. You go through and see the aggregate fund flows, which is where all the big money is going. It has not left just yet. We need more of it to leave. Hedge fund positioning, it's getting there, but it's not quite bearish enough. And then you got speculative positioning, also has not capitulated. So we're still waiting for more pain. But hey, a market like this will do it. Just a matter of time. And like I said, hopefully sooner rather than later, because we don't want to drag this out. We want a swift death. Next thing we could look at is the McClellan Oscillator and Summation Index. That has hit the level that we needed. Same with the percentage of stocks above their 200-day moving average in the Russell 3000, which is like the broadest index we could use. You can see we hit those bottom levels because less than 20% of stocks were above their 20-day moving averages. That's bottom territory. Same thing here, we could look at the same factor, but with the 50-day moving average. We also hit below that 20% level. Good signs. But what we want to look for again is that major breadth thrust, which we haven't seen yet. If we look at the MACD buy signals in the markets, not there. The 5-day advanced decline thrust, also not there. And the up-down thrust, we haven't hit that level either, so we're still waiting, because you want the market to bottom and then make that strong move higher. If you don't see the strong move higher, then it's likely that we have more downside to go. Now, the next thing we gotta talk about, what is all this business about a recession coming? You know, everybody's talking about it, especially on YouTube. Is there any validity to that? The answer is no. A recession is not gonna happen, and you should ignore all those people. Demand is still strong, and household balance sheets are strong. Everybody's got a lot of money saved up, and the housing market is nowhere close to peaking for this cycle. So there's a lot of different things we can look at, but overall, no recession coming. Our own recession probability model in MacroOps says there's a 0% risk of recession over the next 24 months. And in that model, we look at a wide variety of data points, including the rate of change in corporate profit margins, the change in business conditions, housing permits, average hourly earnings, interest cost profit ratio, yield curves, all sorts of stuff. And you can see here recession probability risk is low, and this has a great track record of predicting stuff. You can look at the Conference Board's leading economic index indicator, and it is still quite elevated. And before you see a major bear market or recession, this normally turns negative. So it signals the start, and we're not there yet. So when the LEI is above 0 and falling, that historically leads to average annual market returns of just 0.3%. So you can see this chart right here. When LEI is below 0 but rising, you're gonna get great returns. When it's above 0 and rising, a little less returns, but above 0 and falling, not so great. And below 0 and falling, well, that's rough territory. So at least we aren't there. Now, the historical risk of a greater than 10% annual decline in the stock market outside of a recession is just 4%, according to Goldman Sachs. So that means that by the end of the year, it's only a 4% probability that the total stock market will be down greater than 10% because we're not in a recession. So it's possible that the market heads even lower from here and then stays lower into the end of the year, but it's not likely since a recession is not going to happen anytime soon. Now, can we still see a technical bear market, which means a peak to trough decline of over 20% in the next few months? Of course. The S&P is now almost 16% down from its highs. So what's another 5% or even more? We're in a fast rate hiking cycle and inflation has peaked, but it's going to stay elevated. And all of this is driving a large rotation in investor preferences. So we could definitely see this market fall hard, even harder, but most likely it will recover by the end of the year. And speaking of rotation, that's what I really like about the All-Stars, because I've been seeing the rotation happen in real time. You can see our All-Stars model, if you're using it, it has recovered a lot this year, because eventually when you're tracking momentum like it does, it's going to get into the stocks that are doing the best, right? And you've seen, if you've been tracking it, a huge shift away from technology. Right now we're like in energy and pharmaceuticals, mostly energy though. Names you wouldn't think you would be in, but those are the ones that are performing. And that's what I like about a system like this, is that it's dynamic. It doesn't matter what the name is. We're just going into what works. But again, even with this system, it has been a tough year. No doubt about it. But hey, this is real investing. This is how it goes. But I'm really interested to see the second half of the year, because now we're beating the NASDAQ by a good amount. By cutting off that tail risk, we just stopped out of another position today, cut off that risk. And when things do turn around, how are we going to perform? Most likely much better than the market. And we'll have a lot of cash on the sidelines to do better as well. That's why it's tough to look at the performance of something within a year, right? You want to wait until the end of the year and see what really shook out. And even that 1 year performance isn't that great either. You want to look at 5 years, 10 years. And that's where these systems really shine. But it is always interesting in real time to see that rotation happen in the system. And that's what's happening in the rest of the market. Technology stocks are out. And you know they're out especially because they had the highest valuations. And in general, the market's valuations are still elevated, especially considering the macro backdrop, because you know what happens when rates are rising, all the valuations do get recalculated. But look how elevated these valuations were with this green line right here. This is in 2020 and 2021, but now they're coming back down to their 20-year average, but they've got a little ways to go still. So we still got to clear out those high valuations, which a lot of them, of course, are in tech stocks. So as we said, this has been a very difficult backdrop that we've been experiencing, this economic environment. Not great, and it has been all year. It's been pretty bad. And it's incredibly noisy, so there's literally something to confirm every bias. These volatile sideways regimes, like the one we've been talking about, they are the most painful and they're difficult to trade, especially if you're looking for a very clear bull or bear market. So to sum everything up, recession risk is low to non-existent, which means you want to continue to look for good stocks and buy them in technical uptrends or when they show signs of bottoming. But since bear market risk is elevated and we haven't yet seen broad-based capitulation or bullish confirming breadth thrusts, you want to keep a nice cash cushion, play a bit defensive. Keep your risk balanced and your stops tight. And that's what we always talk about on this channel, managing your risk. That's the most important thing you can do. Now I have another video coming for you Thursday, which might be about a stock that you want to keep on your watch list in the name of looking for good stocks during this time period. But in the meantime, if you haven't already, go check out our last video. I'm going to put a link to it right here. It's about a much bigger trend and problem than the stock market that's happening in our economy and our society in general. You're definitely going to want to know about it. We talked about it in the last video. Again, I'll put a link right here. So go watch that and I will see you again on Thursday. Good luck out there. Don't go crazy.